Hello, everyone. Good afternoon, and welcome to B&M Care's funding webinar in association with SOLLA Accredited Financial Advisors Eldercare Solutions. My name is Angela Hunt, and I'm the Sales and Marketing Director for B&M Care Homes. A very warm welcome to our existing families joining the webinar today, and also welcome to those of you out there stepping into the world of accessing long-term care for your loved one and wading through the minefield that is finding ways to fund that care. B&M Care have been operating care homes for 50 years now, and we take the view that providers like us have a real responsibility to share knowledge with our families as well as the wider community. So today's webinar is part of a series of discovery events that we deliver, which includes things like the Dementia Awareness webinar and the virtual dementia tour. You can just hook back to our website again, bmcare.co.uk/events for any of the upcoming dates for those. So let's move on to today's events. I'm going to hand you over now to Nicky Cave from Eldercare Solutions, who is going to take you through today's webinar on funding long-term care. Over to you, Nicky. Thank you.
Thanks, Angela. Now, with it being Friday the 13th, I just want to make sure, she says, let me just find my slides and make sure they share. Hopefully you can see those. Brilliant thumbs up from Angela. Thank you very much. So yeah, Friday the 13th, it was bound to go wrong with technology hitch. There we are. So confused about care funding? Well, hopefully after the next 55 minutes or so, you will be a little less confused. The good news is this is being recorded. Whether it's this afternoon or early next week, Angela will make sure you do have the recording and you can then share that with family members perhaps or other friends in a similar situation. Being a webinar format, don't worry about your cameras or microphones coming on inadvertently. They can't. But it also does mean we can't take individual questions during this format. But I'll make sure we have our website address displayed on every single slide through the presentation, and I'll make sure you've got contact details at the end. So if there is anything that you want to ask that isn't covered in the next 55 minutes or so, you'll have our details to get in touch and ask one-to-one. So the planned agenda for this afternoon, and I've picked that road sign deliberately because I think if you are trying to navigate the care system for the first time, it's all of those things. It's very confusing. It's easy to get a little lost and disorientated with sometimes overwhelm of information and sometimes conflicting information. So whilst we're going to have people attending today that are very different points in the journey, some people may have navigated quite a bit already and some may be starting right from the beginning. I'm going to take things from the very basic level. So you may know some of this already, but it's best that I would do it that way than assume you have a good knowledge. So there's 4 key points I've put on my agenda for today, and hopefully it will meet with your objectives. And the first is what looks like a very simple question: who pays for a stay in a care home? But it does have quite a complex answer. So we'll spend some time on that. We're going to touch on something called the lifetime cap on care costs that you may come across if, for example, if you were doing an internet search, there is some out of date information. So I just want to make sure everyone's up to date on the lifetime cap proposals. We'll look at whether the family home has to be sold to pay for a stay in a care home. And we'll look at whether it's possible to make sure that the money doesn't run out despite the length of stay in a care home. So we know that it's really important to families that somebody's legacies are protected, that their beneficiaries do receive that inheritance that mum or dad desperately wanted to pass on, and making sure that any sort of savings that were put aside to pay for care, that we can protect that if at all possible. But before I start running through that agenda, let me just give you a bit more of a kind of formal introduction to ourselves here at Eldercare. Now, we are a firm of independent financial advisors, IFAs, who have been accredited by the Society of Later Life Advisors, and that's really a sort of gold standard that you need to look for if you're taking any advice in this field. The issue around SOLLA is that there's quite a broad remit within its membership. So not everybody specialises in care fees funding, whereas here at Eldercare, this is all that we do. Yes, we're IFAs, but if you asked us the first question about pension options or the best mortgage product or cheapest life insurance, we're qualified, but we don't practice in those areas at all. So we would simply say, please go and seek that type of advice elsewhere. Other IFAs who hold the care qualification but don't do it very often may still try and provide this advice, because people don't like to say that, this isn't something they specialise in, but you really, really do need a specialist, somebody that just does care fees funding day in, day out, so they understand the nuances of all of this. That's us. Now, I set the business up. It's my company back in 2007 in its current format. And I did that because I was a traditional IFA previously, covering all of those topic areas. But when my family went through this, journey in respect of my grandparents, I realised later on that there was an awful lot of information that we never got, that we were unaware of. We made some choices that would have been different if we'd have had all of the facts. So when I found out all of the bits and pieces that I wish we'd known as a family back then, I set up the company to try and share the knowledge so that people in our shoes are able to make fully informed decisions with all of the facts. Now, we're here at B&M Care's kind invitation, but we don't have any commercial links with them or any other care provider. We work with many up and down the country, but as I say, that's because we're a specialist and there's hardly anyone that does what we do. So it's no surprise that we do sort of crop up. Our literature is stocked by hundreds, if not thousands, of care homes around the country. We're having money conversations with families, so it's important to note that we are properly regulated. You will easily find us listed on the Financial Conduct Authority's website, which is where you should look for anyone that you're talking to about financial matters. They should be authorised, because that's what gives you consumer protection. Now, I'm talking to you from Hertfordshire, and many of you may be in the sort of home counties. It doesn't matter anymore, does it? Because we have Zoom and Teams and FaceTime. But actually, even prior to everybody getting used to that as a medium, so pre-COVID, we still delivered our advice actually at arm's length. And we do that really to keep our costs down so that we don't have to charge for any initial consultation. But it also just means if we've got everything in writing or recorded, nothing gets lost in translation. Whereas sort of sitting face to face, having a chat in your house, well, where's the record of that conversation and whether you completely understood what I was saying, didn't make a decision based on something that wasn't quite what I said. So it to us is a really robust way of doing things. We know you're busy, and actually, if siblings and members of the family don't all live in the same area, they can all be involved in this if we're doing it on Teams or Zoom or a conference call. So, that's in our view quite a positive. But as I say, it's mainly to keep the costs down so that we can have an initial consultation with you completely free of charge. We can research financial solutions for you at our expense, not yours. Now, we're not a charity, so there is an element of a fee-based model, but not unless you are buying a product, and that might be much further down the road. So that's just a bit of background really on us. Let's get back to the key questions on the agenda. The first being, who pays for a stay in a care home? Now, keeping it fairly simplistic, I would say that there's three possible funding streams. You're either going to be paid for by the local authority, social services, the council. It's all the same place, but we call it different things. You might be funded by our much loved National Health Service, even in a care home. Or you are a self-funder, also referred to as a private fee payer. There can be some overlap between the three, but that's just keeping it simple. So if we take them in turn, the local authority funding is probably the more complex there. And if you do know about local authority funding, you will probably think or know that it is linked to how much money a person has. So it's means tested. But what a lot of people don't realise that there's a sort of a bit of the process that we have to go through before any conversations about money take place. In other words, the local authority is supposed to assess somebody's care needs first without digging into the finances. So they have to assess whether somebody meets their care eligibility criteria, yes or no. If they don't, if they think that person doesn't need to be moving into a care home and could be supported, for example, in their own home, then the conversation kind of ends there and there's no further discussion around the funding. Now, people perhaps either don't know about this first gateway, or they just assume, well, if you ask for a care assessment, you'll qualify. Age UK did a survey that suggested about 1 in 5 people that ask for their needs to be assessed don't meet the local authority's criteria, so the door is shut on them. So you have to meet the criteria first. The local authority has to agree that you need to be moving into a care home. Then the money conversation takes place. And the money conversation, the financial assessment, is more commonly referred to as a means test. So if you do know anything about this, you will probably know the amount of money and the trigger point for social services funding, whether you have above or below a certain figure, and you'll probably know the figure because it hasn't changed in something like 12 years, so it's actually going backwards, and that figure is £23,250. Now, people talk about free care in Scotland. In Scotland, the capital limit is actually only a little more than that. It is at its most generous in Wales, where it's £50,000, and these limits are per person. So if it's a couple we're talking about, then you double these figures. So you can see why it might be deemed quite generous actually in Wales. And you don't have a lower capital limit in Wales. It's a straightforward, you reach the 50,000, the local authority funding kicks in, and you don't have to contribute anything further from those savings. You do have to contribute income, and I'm going to talk about that shortly. Whereas with our system in England, if you reach the 23,250, you're still expected to contribute from that capital until that capital reaches 14,250. So, if you were in care a long time, you could argue that it's actually only 14,250 that's protected. Now, when they do this means test and they're asking you about the capital that the person has, what counts as capital? Well, it is pretty much everything, but I'm going to just take you through 3 notable exceptions. They may not all apply to you, but it might be that one or all does. So if we are talking about a couple where just one of them is moving into a residential or nursing care home setting, it's the individual moving into care who is assessed. You are not assessed on your joint finances. So 100% of the capital owned by the person staying at home, not needing care, that's not disclosed in the means test. You keep that information to yourself. If you have joint accounts, then 50% of the value of the joint savings or the joint accounts, that does have to be declared, as does 100% of your own capital if you're moving into care. So we do know that people structure their finances a certain way for tax reasons, when they're working. Once you're retired, I think there's a lot to be said about just equalising things, but also to equalise them into your own solely owned accounts. Because if you keep all the money in a joint account, the joint savings have to drop down to the 46,500 threshold before that person qualifies for support. Whereas if the individual staying at home takes theirs out, it doesn't come into the equation at all. So it's not doing anything you shouldn't. It's not deprivation of assets. It's just saying if there's joint owned savings, joint owned investments, put those into your sole names 50-50. Don't hold them jointly. There's a really good Age UK fact sheet that will confirm this, so you don't think I'm making it up, but also probably explain it a little clearer. So anybody moving into care, part of a couple, you're assessed as an individual, not as a couple. And the property, I assume people know this, but we have a lot of worried people saying, oh, the local authority are going to come back and claim against the house, etc. The house, the family home, is a completely disregarded asset if the spouse remains living there, or indeed if a relative over 60 lives there, but they have to genuinely live there, not have just moved in a year or two before mum or dad moved out, and a couple of other exceptions as well, but these are the two main ones. So that doesn't mean that the property is ignored for now and the local authority will come back and get the money later. They can't come back and get it later. The entire time that it's occupied by a spouse or a relative over 60, it's exempt. And the only time the local authority can include the value of that property is if the spouse at home predeceases, the one in the care home, and then from the date of death, it's included, or if the spouse at home themselves moves into care. And then from that date, the property value is assessed, for both of them. So we hear about, putting charges against properties and so on. That should only happen if the property is being taken into account, i.e. no one is living in it, or it's a tenant or somebody that doesn't trigger that disregard. So if you're unsure about the property, belonging to your loved one or yourself, and you don't know how it would be treated, check it with us. But it's really, really important to note that there are these two important disregards: a spouse living there, relative over 60 living there. It can't be included as an asset in the means test. The third exception, not probably quite so common, but actually more common than you'd think. If somebody has taken advice over the years, probably from an IFA, you wouldn't tend to buy one of these yourself directly. But if you have taken advice and been recommended to buy an investment bond that includes life insurance, and you can probably tell that from the wording of the policy documents, where it would say lives assured or 101% bid value paid out on death. They're the sort of two trigger terms. Those types of investment bonds are completely disregarded, even if there was £1 million in there, provided they haven't been purchased, just as somebody was moving into care because they'd heard that they were a disregarded asset. If you bought one just purely for standalone reasons to try and get a better return than you would do in the bank, the side effect is that it doesn't get included in the means test. Now, you may still choose to cash it in and use it to pay for care, but the point is, don't rush to do that unless you've sort of spoken to someone and worked through the pros and cons, because if you leave it where it is, it's disregarded. So they're the main exceptions. Pretty much everything else, by which I mean stocks and shares, premium bonds, ISAs, holiday lets, second property, shares in a business, cash under the bed, all of those are included in a person's means test. So it really doesn't take a lot of wealth to put you over that 23,250 threshold. In fact, most people would be over that, the exception being if everything is held up in bricks and mortar with a spouse living there to protect it. It doesn't stop there. That's just the entry point, how much capital you have. If, let's say, you only had £20,000 of assessable capital and you think, okay, so I'm entitled to local authority funding. First, you've got to pass that care needs assessment. And second, they will look at how much income you have, because you are expected to contribute your income towards what the local authority will pay. And it is possible, if somebody had a very high pension income, perhaps they were, working for the same company all their life and they paid a really good pension, it's possible that they might have more income already than the local authority would pay for them. So they don't get anything, even though their assets qualify them. Now, if we are talking about a couple scenario, and if that person has a private pension, the one going into care, they can pay half of that private pension to their spouse who stayed at home, but their state pension and the other half has to go towards what the local authority pay. And of course, the local authority isn't just going to pay whatever a particular care home might be asking. They'll have a limit on what they pay. Now, that has to be arrived at a certain way. They can't just have a list of figures on their website and say, this is the most we pay. They have to actually assess a person's needs and then find a care home place that will meet those specific needs and pay for that care home place in full, accepting that the individual has to contribute their income towards it. But they can't only just give you a list of care homes in the area, say go off and find one, and then you talk to all the care homes and they say, well, we don't take local authority funding, it's not enough, you'd have to pay a top up. There must always be at least one care home place offered to that person to meet their needs and that does not require a top up. In other words, the local authority has to pay full cost. It's illegal for the local authority to not offer at least one care home place that doesn't require a top up. Now, having offered a care home place that doesn't require a top up, if the individual or the family don't like it or would prefer a different care home, then they can ask the local authority to pay that monetary amount to a different home, but they must accept that that different home could well ask for a top up if they are more expensive than the one the local authority has sourced. So that's when you can legitimately be asked for a third party top up. But of course, some people don't have family members who could afford to pay a top up. That's why there always has to be at least one zero top up option offered. This is if you are funded by the local authority from the outset. If you're not funded by the local authority from the outset, you're self-funding, you choose your own care home and you move in and pay for it, the money runs out, perhaps the person's lived there longer than they expected to, or just simply outlived their capital. In that scenario, what happens? Well, the local authority does their assessment. They would ideally try and keep that person where they are, but it actually becomes a matter for the local authority and the care home to sort of talk to each other and try and see if they can come to an agreement about a mutually acceptable fee that would allow that person to stay there. If they can't come to an agreement and the care home simply can't accept the lower level of local authority funding, that is the only other time a third party top up should be requested. Now, ideally, you would know whether this was going to be happening in the future because you would ask this type of question when choosing a care home. You would say, we're self-funding, we see what your fee is, what would happen if we could no longer pay that in the future? If it happened very soon after somebody moved into care, I think, there's a good chance the care home might ask that person to leave. If it happens, X years into their stay, then I'm sure it would be a very different conversation. But it's something that's perfectly reasonable for you to ask when choosing a care home and be clear what the position is likely to be so that there are no surprises further down the road. We'll talk shortly about how that whole situation might be avoided in the first place, because no matter what reassurances are given, things change. Things change for the local authority in terms of budgets, things change for care homes in terms of what they can afford to take. So in an ideal world, a self-funder would be able to secure their ability to pay for life, and we'll look and see if that's possible. So that's our sort of means tested system, a whistle stop. We've had that system for decades and it hasn't really changed in all that time. But as I say, if you did an internet search, you might have something called a lifetime cap on care costs get brought up. In fact, we had somebody ask us about this just yesterday. When is this cap happening? It came in a couple of formats. Sort of 12 years ago, it was due to come into play at a figure of £72,000. And more recently, it was a discussion around an £86,000 cap on care costs for self-funders. The idea being that, if people do live in care for many years, the effect can be catastrophic. They can be eye-watering sums that somebody might spend. So the idea of the cap was to protect people from that. I think you might sense a but coming here. Up until a year or so ago, I would have spent the next 5 or 10 minutes explaining how the cap was going to work, that it wasn't really a cap because it was based on local authority contributions, not what somebody was actually spending on their self-funding care. It didn't allow for hotel and breakfast food costs as such in there. And the long and short of it was going to take most people about 4 years to reach this cap. And by that time, they would have spent, £250,000, not 86,000. But it's all academic because it has been once and for all cancelled. And I know that there's talk going on in government about, changing the social care system, but not very much of it seems to be around the finances. It's more about the delivery of service. So for now, and for the foreseeable, I would suggest just work with the local authority means tested system. Anything else you read about a cap or a limit on what you might spend, it's out of date. The only other potential funding stream you have, if it's not the means tested local authority support, is potential National Health Service funding. I say potential because this is very difficult to qualify for. It can only, in any event, be paid to nursing homes. So any care homes that are just set up for residential, they can't receive this type of funding. And the idea of it is really that, in layperson's terms, if you were in hospital and you were receiving care on a ward, you know that when you leave, you're not going to be invoiced. Okay, we have a private system, but if you go into an NHS hospital, you're not asked to pay for anything. If you have those similar needs, so complex, unpredictable, unstable nursing care needs, you need medical support rather than just that of a carer, then just because you're in a different setting to a hospital doesn't mean that the NHS should sort of wash its hands of that responsibility. So if you're receiving the same type of medical nursing care that you would get on a hospital ward, but it's in a nursing home, the NHS still pay for it, and they pay for all of it regardless of your means. But as I say, they are looking, when they do the assessments, for complex, unpredictable, unstable needs. So you could be very poorly looked after by a nurse, but if you are stable and your care package looks the same every day, they may well not award continuing healthcare support. This, by the way, is a whole event in itself, and it's not something I'm medically qualified to deliver. I'm just flagging it to you today so you're aware of it. Again, there's an excellent Age UK fact sheet that delves into the sorts of things that they're looking for when they do this assessment. If you need nursing care and you don't qualify for the full funding, you do still get something. Again, you've got to be in a care home registered to provide nursing care. And this funded nursing care weekly contribution goes direct to the care home. But the idea of it is that it normally bridges that gap between a residential rate and a nursing rate, so that if your needs increase, you don't actually necessarily have to find more money to fund the extra. The NHS 254 a week might well be enough to bridge the gap. So it's not something necessarily that would feature at the start of everybody's journey, but if health deteriorated or health needs change, then just be aware of this. And certainly the care home, if you were in a residential care home, they would be saying, we can't meet your needs anymore. And then it would be a case of finding a nursing home. Know that this funding, at least at the lower level, would then be forthcoming. So that's our NHS no cap. The powers of deduction say if you don't therefore qualify for the local authority funding because you've got too much money, you don't get the NHS funding because you're not poorly enough, that's what puts you into the self-funding category, and you have to pay for the care yourself until the situation changes. Unfortunately, there's not a lot of support for self-funders other than, if you already know about this, I already know. If you don't, it's the only positive bit of news I have for you today, really. If you haven't heard of it, there is a state benefit, non-means tested, tax-free, called attendance allowance. Some people will be already claiming that in their own homes if they need a bit of help with washing, gardening, Meals on Wheels, somebody popping in for a bit of personal care, they should already be getting this. If you've never heard of it and think that, well, if I'm going into a care home self-funding, I don't get any support, you do get this. This is for self-funders. So it's either paid at these are next month's figures, £76.70 a week or £114.60 a week. The difference between the two being whether you need somebody to help attend to you during the night time, as well as the day, or just the day. Most people in a care home, by virtue of being in a care home, 24-hour care, would get that higher rate. It's not a huge amount, but it's nearly £6,000 a year tax-free. So if you're not aware of it, absolutely get the claim done. The claim form is horrendous. It's very long, it's very repetitive, and you kind of need to know what they're looking for to not get tripped up. We have found an amazing company, a small family-owned business that we can put you in touch with, that they will fill in the form for you over the telephone, and they have a 95% success rate getting the claims approved. That is so much easier than wading through it yourself. They don't charge unless it is a successful claim, and then they take something like a £300 fee from the first attendance allowance payment. So once their fee's gone, that's all money tax-free to you or to your loved one. So, it's not a lot, but it is an entitlement, and I would urge you to make sure that you claim that. The only time the attendance allowance stops is if you become local authority funded, and then they don't give it to you anymore. If you're in hospital for more than 4 weeks, and a couple of other exceptions around the property, if you're getting some support temporarily from the local authority regarding the property. So that local authority funding support that could come to you if you have a property, I appreciate this doesn't apply to everybody, but I just need to flag it in case it does apply to you. If that property is not left occupied by a spouse or the relative over 60, it might be tenants moving in, it might be vacant. If you are moving into care on a permanent basis and you have less than the 23,250, the local authority has to disregard the value of that property for 12 weeks. After the 12 weeks, it's suddenly there. The value is included in the means test. But for the first 12 weeks, it's as if it's invisible. What's the point of that? Well, it just means then that the local authority is going to pay for you for those 12 weeks. They're not going to lend you money, they're going to pay for you for those 12 weeks. The idea being to give the family a bit of time to sort of think about what to do with the property. Now, during those 12 weeks, obviously, if you don't meet the care criteria, they're not going to pay. You have to go through that entry gate first, and you still have to contribute your income towards what the local authority will pay. And the local authority will only pay what they would pay a care home that they were placing somebody in permanently. So they'll use their limit. They won't necessarily cover the full cost of the care home that you've chosen. So all in all, it might only end up being a £300 or a £400 a week contribution for 12 weeks. So considering the hoops you may have to jump through to get it, you may decide not to bother, but you are entitled if you fit that criteria. At the end of the 12 weeks, then you've got to make a decision, and we'll come on to options there, because we said, does the family home have to be sold? 12 weeks certainly isn't enough time to get a property on the market and off the market sold. So yeah, it might give you a bit of breathing space, but you've still got to make a decision about what you do. Now, some families might think about renting property out rather than selling it, and that's absolutely an option. It's an option that you should probably discuss with a professional, just to make sure that you're taking into account the correct income tax that would be payable on the rent, that you are aware that capital gains tax might start accruing after 3 years of moving into care, so it's not such a feature, but that you think about having a void period, or not being able to find tenants, or having disruptive tenants, or tenants that damage the property, or that there is just general wear and tear that you have to repair. So it comes with its own pros and cons. The biggest downside is that for most people, even when they do the calculation, including the tax, they work out that the rent plus the attendance allowance plus the pensions is still not enough to cover the care home fees in full. So then they think, well, okay, we'll just get a mortgage out then, do equity release or something. Now, you cannot get equity release in this situation. You've either already got equity release, but then when mum or dad moves out, the equity release needs to be repaid. Or if you try and take out equity release when the owner doesn't live there, no one is going to lend to you. Okay, one of the criteria for equity release is that it's got to be money borrowed by an owner occupier. That's not happening if mum or dad's moved out into a care home. Can work very well for funding domiciliary care. Don't get me wrong, there's absolutely a place for equity release to pay for carers in one's own home if that's what somebody wants to do, but it doesn't work in this situation. So does that mean you would have to sell the property even if you wanted to rent it out? Well, actually, not necessarily, because the local authority have their own equity release scheme. They call it a deferred payment agreement or a deferred loan, but it is in essence equity release. It's a loan secured against the property that is paid back when the person dies or sooner. So you could rent the property out, find that you still have a shortfall, and apply to the local authority for a loan for the gap, for the funding gap. All local authorities have to have a scheme in place. They might not lend to individuals, but they'd have to have reasons for that. They can't just blanket say, we don't do this. The reasons they could turn you down will be because you've already got a mortgage on the property. They have to have first charge, so they're not going to lend if there's already an equity release or a mortgage on there. They're not going to lend if the value of the property is quite low. They're going to want to see at least 2.5 years of equity in there to secure the loan against. And of course, if there's any sort of normal standard structural problems, they won't lend. But for most people I would say fit the criteria and they could have that loan made available to them. Now, the local authority will charge interest and setting up costs, but I would suggest it's quite a bit lower than an equity release mortgage product would cost. Not that you could get that anyway, but even if you could, you have got to meet their care eligibility criteria first. All roads lead back to that first gateway. Your assets have to be under the threshold. So you could start off, if you had more than 23,250, you might rent it out, cover the shortfall from savings for a while, and then when the savings drop to the threshold, that's when you can apply for the loan. And the great news here is because the local authority are lending the money, they're going to get it back. They don't have to restrict it within their sort of budgetary constraints. They don't have to say, oh, that care home's too expensive. They're going to get the money back and they have a pot of money that was made available for this reason. So they should lend what you need. You still contribute all of the income towards it to keep the loan to a minimum, but it is a solution that can work for the short term, just to sort of fund those few months while you're waiting for the property to sell, or for the longer term if you want to rent it out. And as I say, it follows on from the 12-week disregard. You get your 12-week freebie first. Don't rush straight into the loan from day one. So be aware of that. Not for everybody, but we can chat it through if you think it's something to consider. Otherwise, if we take self-funders in a much broader context, so the house might already be sold, or there might be savings and investments on top of the property value that mean, talking to the local authority is just not going to feature. You're really out on your own. We are talking to self-funding families all day, every day of the week. That's our role. And when we're talking to the families, normally the sons or daughters or nieces or nephews, or occasionally a solicitor or neighbour, usually acting as a power of attorney or a deputy. That's the sort of typical scenario. They're saying to us, look, we're looking around for a care home for mum or dad. We're being told what the weekly fee is, but we don't know if we can afford it because we don't know how long mum or dad is going to live in that care home. We don't have a crystal ball. How can we possibly work out if the money's going to last? And that's a really valid question. What we can do at this stage is not necessarily predict. We don't have that crystal ball, but we can at least work out with the family how long the money would last. And what most families will have not taken into account, they sort of take the weekly fee and multiply it by 52, divide that into the assets, and then that's how long they think the money will last, forgetting that the pension, the attendance allowance, maybe, private pension, all of that now can go towards the care home fee because the care home fee is all inclusive. They're not having to pay bills on top or grocery shopping. So all of their income pretty much usually can go towards the care home fees. And therefore, rather than dividing a gross fee into the savings, once you divide a net fee into the savings last a lot longer. So just that in itself might mean, oh, I thought we had only enough for 2 years. Actually, you've got enough for 3.5. That might lead to a very different decision. And you might choose that number one on your list care home rather than choosing a cheaper one because you thought the money would run out after 2 years. Even if we do that cash flow projection, as I say, we don't know how long somebody will be there. So we don't know if the money will run out. And that really is the major concern for most families because it's quite difficult to get definite, guaranteed responses about what would happen. Will the local authority definitely pick up the tab? We certainly don't know how much they will pay, and therefore it's quite hard to work out what top up might be requested if indeed it would. So we're fully aware that these are the worry points for families when choosing a care home, and our job is to try and alleviate these concerns. Now, we cannot do that in all instances. Sometimes we'll talk to a family, do the cash flow projection, and they've got enough money to pay privately for a year, or maybe a year and a half to 2 years. There are no solutions. Obviously, we can talk about claiming attendance allowance to make the money go a bit further and that sort of thing, but there's no solution that we can come up with that would stop that money running out if mum or dad is in care for the 18 months to 2 years. The minute we start to get to the point where the net savings, taking into account income, the assets would last for upwards of probably 2.5 to 3 years. At that point, there might be a solution that would take away all of these concerns, would take away the worry of outliving somebody's capital. It's a really, really unknown solution. There are roughly 85% of families, self-funding families, currently paying for care in care homes that have no idea this solution is out there. It's a shocking statistic because this is a financial product that is only relevant for self-funders paying for care in a care home or a care agency in their own home. So you've got a very, very bespoke audience for this product. Only those people can have this product, and only 15% of them ever get to hear about it. Now, my family were in the 85%. We were never told about this. We never stumbled across it. We didn't really use the internet back then, but we certainly didn't stumble across the information, and no one told us about it. So we merrily sold the property, spent all the money, and were unaware that there was an alternative. That's why I set the company up, not to tell you that you must have one of these, but to tell you that these exist, give you a bit of information about them, and then at least you as a family can assess whether it's something you want to look into, want to research, or whether you want to disregard it, but at least you know about it. That is the sole aim, really, of our company, is to make sure that self-funders are fully informed of all their options. Most self-funders are going one route and one route only. They are pay as you go and hope the money doesn't run out. So this is an alternative to pay as you go. It's not to say pay as you go is wrong. And of course, pay as you go, if you've got lots of assets, you're not worried about the money running out, or you think that, the care only needs to be funded for a short period of time, then that's probably the right way to go. But compare it with this, get the facts and figures about the alternative, and then make that informed decision. So I'm talking about a way of capping costs yourself and using, in effect, a type of insurance policy to do that. I use the term insurance. Some people hate the word insurance, but at least we kind of know what it means. However, with insurance, normally you have to take it out before the event, don't you? You have to buy insurance for the car before there's a car accident. You have to insure the house before there's a leak. The technical term for this is called a care fee annuity rather than insurance. I should probably put that out there straight away. But you can't insure care home fees in advance like you would do with your car or your house. You can only insure them at the time that care is needed or after you've moved into care. That's actually almost like the trigger. You used to be able to buy pre-funded long-term care insurance, but the insurers stopped doing those years ago. So, moving into care or just after, that's the point that you are eligible for one of these. And as I say, rather than care home insurance, it's technically called a care fees annuity. The problem again with that name, I didn't come up with these names. The problem with that name is that people confuse it with a pension annuity, or they think they've heard of annuities. And then we have people, even people in financial services, solicitors and accountants and the like, saying to people, oh no, annuities are expensive. You don't want one of those. Well, if they're talking about pension annuities, perhaps I would agree with that, because a pension annuity or a retirement annuity is taken out typically in your 60s. Going to pay out for 35 years, maybe. It's going to need indexation. It's going to need a widow's pension. All of those things mean that when you swap your lump sum for an income, which is what an annuity is, it's an income, the insurance company doesn't give you very much in return for that lump sum. You might get like a 5% return because they might be paying out for 20, 30 years. Okay. But with a care fee annuity, it's similar in that you're paying a one-off lump sum, giving it up, handing it over to an insurance company in return for a guaranteed income for life, which, by the way, would be fully tax-free if it's paid to a CQC care provider. The difference being they're individually underwritten and take into account the person's age and state of health. So they're unlikely to be 60. I know some people move into care young, but the average age of the people we get quotes for is actually 89. So the insurance companies aren't expecting to pay out for 30 years. They may be expecting to pay out for 3 to 5 years. You can't have a widow's element attached, they're just individual. And if that person has a dementia diagnosis or a heart condition or has had a stroke, all of those conditions are taken into account when they tell you what income they will give you in return for your lump sum. So our job here at Eldercare is to work out what somebody needs, so to work out what the gap is between care home fees and existing income, and then to go out to the insurance companies, a bit like the Meerkat, the Go Compare Meerkat, to go out to all the insurance companies and get quotes for what would the lump sum be for this person who needs £50,000 a year to plug their funding gap. You know, how much are you going to charge? We go to the whole of market, we get the underwritten quotes, and then we come back to you with a report, a written report for you to share with your family. We don't come and present it so that we're there sort of biasing whether you should do it or not. We just give you the facts and the figures in a really clear, plain English report, and it'll answer all the questions you're starting to think of now, like, well, is it portable? What happens if mum or dad moved care home? And it will tell you that you can move it. It's portable. It belongs to them, not the care home. It'll look at what the cost might be to build in escalation to protect against future fee increases, for example. You don't have to include it if there's enough money left over to fund the fee increases. You can just have a flat level annuity, which would be cheaper. But we look at all these options for you and with you. These are fundamentally a gamble. They are a gamble around somebody's life expectancy. And of course, the insurance companies win if you look at it over a period of time and as a collective. But on individual cases, some of them they win on, some of them they lose on, and some of them they break even on. But they can afford to lose on some, you know, because they've got hundreds of thousands of clients and they're going to be making on others. But you as a family have probably just got the one pot of money. So your attitude towards the loss or the risk of loss will be different to the insurance company. So yeah, of course they win most of the time, but sometimes they lose quite heavily. We have had clients that have, you know, outlived the break-even point of these annuities by, you know, 3, 4, 5 years, almost sort of doubled the money, as it were. So whatever, it's personal choice, right? This is about what risk a particular family is prepared to take. What's the alternative look like? You know, it's risk to pay as you go. If the money could run out, that's a risk. This is a risk if you pay a lump sum up front based on somebody living, you know, X years and they don't live that long, you probably won't get any money back. So that is risk. One is a risk against longevity. One is a risk against early death. You can mix and match them, by the way, but that's a whole nother topic. Now, if you don't like the look of the risk, it's too much of a risk, then there are ways to try and mitigate that with these policies. You can pay extra and include capital protection, a form of life cover, or you can buy them with a delayed start date so that you still buy them now. You still got the protection if they live a long time, but if the policy doesn't start paying out for the first year or the second year, you hold that money back and pay it yourself, you're giving the insurance company a much smaller lump sum. So you are risking a much smaller lump sum. You know, we've heard people talk about deferred policies as in, oh, do you want the income to start now or in the future? Well, if I asked you that, you'd all say now. But if I said, do you want it now or in the future? And if you have it start in the future, you can give the insurance company half the money that the immediate one would cost. You might want to look into that in a bit more detail. And we certainly do that with you because we're specialists, because we want to give you the full range of advice and make sure you've got all of the facts. Our deferred options will be in there, and about 30% of our clients take that option. So it obviously has some merit. The report will also tell you things you need to know, such as, this product is fully protected by the Financial Services Compensation Scheme, no cost cut off, it's 100% of the income. All those, small print matters that you would need to know before making a decision will be in the report. Now, just to sort of put it into a different format, for some people that prefer perhaps a visual version, let me just quickly take you through a case study. That's not really Mrs. Evans, and we did change her name, but the case study is correct. One of our clients, aged 88, she'd had a stroke, couldn't live at home independently any longer. Prior to this stroke, she had actually built a relationship with a local care home. She'd been into a couple of community events, met some staff. She knew that that was the home she wanted to go to, should she ever need it. All of a sudden, we are now needing it, and she's a bit more focused on the cost and a bit more worried about whether she can afford it. It was actually her daughter, power of attorney, that got in touch and shared with me that mum really had always wanted to make sure the grandchildren were left some money, and that some of the charities that she supported, did receive income and a lump sum via her will. So she was, quite worried about spending everything, and she would have almost, penalised herself and chosen a cheaper home just to achieve those objectives. So the family, wanted her to have the best care, wanted her to go where she wanted to be. So they had a chat with me about the finances. So, as I say, talking to the daughter, she shared the numbers with me, and the care home they were talking about in the Midlands was 1,200 a week. Mrs. Evans did have a pension attendance allowance totaling 15,000 a year. So still leaving quite a gap, just under, £50,000 a year. She said that they'd got nearly enough for a year at bank, correct, about £50,000, and they were selling the property. They'd already made that decision not to want to keep it or rent it out. So on the face of it, £300,000 to cover just under a 47,000 a year shortfall for an 88-year-old. Pay as you go. Quite probably that would be, and actually that was what they were considering doing, and just mulling over where to put the money once the property was sold. Premium bonds, ISAs, what should they do? They were in the 85%. They had never heard of a care fees annuity. So I just explained to them that, look, this is how it looks if you pay as you go. We have no idea whether we'll reach year 6, the point at which it says the money will run out. It's a possibility. And even if she doesn't live for 6 years, it's quite a dent in the capital if she lives for 4 or 5. Not that much money left for the beneficiaries. So that is an option. But let me talk to you about the care fees annuity, explain the concept, and they did the research. Free of charge, no obligation. We have a really, really strong view. We could charge for research, of course we could, and we could certainly charge for our professional advice report that's been built on 25 years experience, but we don't, because we don't want that to be a barrier. We know that until people have got the report and understood it all, that's the only point at which they can make a decision. And if we levy charges for research and charges for the report, and someone doesn't even know if they can afford it or want it, it puts people off. Fact. So we've made that decision not to charge for the report. So they were able to make an informed decision and walk away if they didn't want the annuity. Now, they did decide the annuity worked a treat for their situation. Please ignore these figures because it will be different for you. But in their scenario, an annuity cost £165,000 to pay £47,400 for the rest of her life. So roughly, just over a 3-year break-even point. Now, they were viewing it more as, gambling, just over half the estate, in order to protect just under half and make sure that those legacies could be fulfilled and generously fulfilled, with 135,000 left over. As I say, horses for courses, and different people will structure it different ways, but that's how it worked for this family. And it just meant that it looked very different. It saw a big dent into the finances to start with, but then it flatlined. The money couldn't run out once the purchase had been made. Now, that assumes that we'd factored in future fee increases and that she didn't move to a more expensive care home. But even if those things happened and she had gone the pay-as-you-go route, she'd still have to find that extra. So it's still very much like for like. In that scenario, if somebody needs more expensive care, then there's a good chance the NHS funding would cover it. But we will do those cash flow forecasts, and we will never recommend a care fee annuity if it leaves somebody with such a marginal fund of money that they can't cover those eventualities. Then they might be better off not having it. So the reason they did it was to ring fence the remaining assets, make sure that they never had to knock on the door of the local authority to ask for funding. Once you have an annuity, you're never going to get local authority funding because you're going to have too much income. But if it's been set up correctly, that's the whole point of it, that you don't need LA funding. You can fully privately fund for life. If you did qualify for NHS funding at a future date, you'd still get that. Then the NHS funding is not going to be affected by this. You just wouldn't need this income anymore and it would be paid into your bank account, albeit taxed. As I said, we make no charge for researching it. We are just paid a fee if a purchase is made, and that fee is included within the quotes that we obtain. Our fee, I would have to say, is at the top end. There will be brokers out there offering cheaper fees, but if they're offering cheaper fees, they're unlikely to be a specialist, first and foremost. And we, because we are a specialist, we write 20% of the UK's care annuity business. That's 4 companies. We place 20% of their business. They quite like us. They're quite obliging because of that. And that means that if we need to ask for a discount for our clients, we're likely to be given it, okay, because of that good relationship. Any flexibility that we need, if we just want the start date changed, or we want a bit of, please could you do this, they are very amenable to those conversations because they know us very well. A broker who does 1 or 2 of these a year, as opposed to the sort of 250 odd a year that we do, they're going to get a different response. So that is the benefit of using a specialist, and you may have to pay a little bit more for that, albeit only if you buy. So I would say to you, if you want to look at the care annuity, you do your due diligence, you choose an advisor, but then just instruct one. It gets really complicated and messy if you have 2 advisors going to those 4 companies. Only one of them can be set up on the system to get all of the information to update you. The second one just sits there in the dark. And if we are the second advisor on a case, we actually usually say we won't be instructed. You stick with the one you've already got dealing with it. So do the due diligence first, make sure that the advisor is accredited by SOLLA, is clearly and easily found on the FCA register. And if I were you, make sure that there's a whole raft of independently verified client reviews about care fee annuity advice, not great reviews about pensions, not great reviews about investments and mortgages, not if you're looking for care annuity advice. So do the due diligence. Obviously, we tick all of those boxes, so you could make it easy and just come straight to us. But I fully understand if you feel the need to shop around, but just instruct one. And if you're really not sure whether the annuity is even a starter for 10, we on our website have built a care fee annuity calculator. It was the only one of its kind until a competitor decided to copy it. So there's now 2 of its kind out there, but we're the original. And basically all you have to do is put in the age of the person you're considering this for, how much income they have, and what the care fees are likely to be. And it will work out a ballpark figure for you based on quotes we've obtained over the years for people of the same age. So it is an average, and it won't have been underwritten, of course. So it could change when you apply for it officially, but it will give you that within 10, 20, 30,000 sort of ballpark, so that you can consider whether it's even worth looking at. Obviously, make sure you work out the shortfall correctly, make sure you've got the correct annual care fees, correct annual income. Allow a little bit for personal expenses if you want, but usually we recommend you sort of cover that from remaining capital, and this will give you an idea. If you then want to talk that through with us to get a bit more information about the data that sits behind it, how likely is it to change, have you worked out the shortfall wrong, then you just get in touch. There's a facility on the website to email us, or of course just ring us, old-fashioned telephone 0800 082 1155. Office hours, I would suggest not this afternoon, but next week onwards, or just drop us a line over the weekend to the Eldercare Group, advice@eldercaregroup.co.uk. bn.co.uk address, and we can respond that way. So lots of other information there on the website, but hopefully what we've done in this sort of 55, 60 minutes is make it a little bit clearer about the means tested system, who qualifies for state support and how they work all that out, what's taken into account, what's not, how the NHS system works loosely, and that is something that could feature in the future. That if you are a self-funder, there's the attendance allowance to claim, and if you want that company I mentioned who can help with that, drop us a line and I'll put you in touch. We looked at some support that you could have if there is a house to be sold. And then we spend a bit of time looking at the care fee annuity as a way of capping costs yourself, coming with its own risk, of course, but at least now something that you might have flagged up awareness to explore. So hopefully that's left you a little bit more informed than you were an hour ago. I thank you so much for your attention. Angela, as I say, will get the recording around to you probably next week now, I would think, so you can share away. And if you've got any further questions about B&M themselves, contact Angela. Anything on the financial side, anything I've covered this afternoon, please get in touch with us. So thank you so much for your attention and have a really lovely weekend. Thanks very much. Bye.